Well, good morning. Thanks for making it down here, especially those of you in person. I think we have a lot of people online too. My name is Matt Thompson. I am the business bank and market leader in Minnesota, North Dakota, and South Dakota. Hopefully, I have some of the Dakotas on today. I'm not sure yet. We'll find out later. But welcome to our event. Jeff, how many times have we done this now?
About 7.
This is our 7th time. So Jeff and I are pioneers for the 1031 event. So obviously I'm in business banking, but people don't realize that we also do commercial real estate lending as well. That's why we put this on. So I'm not speaking very long, nor should I, because you don't hear from me, but I'll give my Jeff Peterson plug. I've done 2 1031s with Jeff, one earlier this year. I thought it'd be a good idea to get out of Minnesota and buy a place in Cape Coral, Florida. So I went from no evictions to a hurricane. It's been a heck of a year, but it's a good thing anyway. So highly recommend that 1031. I think I'm turning over to Norm, right?
Norm's going to go first.
Norm's first. All right, Norm, do you need a mic?
He does. And drop.
Hey, good morning, everybody.
Good morning, everybody.
Good morning.
I'm Norm Jones from Winthrop and Weinstein. I've known Jeff for many years. Our firm, one of the things our firm specializes in is real estate development and tax credit driven real estate development. The low-income housing tax credit, the historic tax credit, and in the last 10 years, the energy tax credit, solar development. I've done all of those and some more, but in the last 5 years or so, all that they really let me do, because of the explosion in solar financing, is solar. So there is some overlap in terms of the solar credit and real estate development, and we'll try to explore some of that. But one of the things that I get asked about a lot is this Inflation Reduction Act that passed last fall or this fall, and what its impact is on solar development, other renewable energy. Is there any crossover into real estate development stuff? Yeah. Raise your hand if you're a real estate lender in this room. Is that everybody? Almost everybody? Okay, so there's some stuff in the IRA that's relevant to real estate development. We have a bunch of slides. I'm just going to do. There's a lot in the Inflation Reduction Act, most of which you just couldn't care less about. But some, you don't know what you're going to care about until I just want to get a lot of these seeds planted in your head, because next time you might be talking to a customer and they say the word energy in the context of whatever they're developing, your ears should perk up. And I want you to be, I want you to be the first one to tell them, well, you know what, there might be something in the Inflation Reduction Act for you that rings a bell. Why don't you check that out? Maybe that's helpful. You're the one helping your customer, and that makes you look good. So just a brief background. What I do is Section 48, which is the solar tax credit financing. Years ago, well, let's just start with the slides.
Let's do it.
I'm just a dumb lawyer. They don't teach me how to do this stuff. Oh, it works. Okay. We're gonna, so our practice is nationwide in terms of financing solar farms. But little known, the credit, most federal benefits or federal credits in the code apply to the territories as well. So Guam is, I'm not even gonna get the technical term, but one of the projects we did this year was a utility scale project in Guam. Guam is a little island. There's a few tens of thousands of people living on it. This project, you can almost see clouds below the drone there. That's how high this drone had to get to view the whole project. There's also some battery storage, which is another technology that's coming into play to back up these solar farms. And this single system that just came online this year that we helped finance basically transforms the whole island's energy infrastructure, from waiting on the next tanker containing fuel oil to get there, with all the supply chain that implies, to having moved up the scale to energy independence on this island. So it is, 10 years ago when I first started doing this, we would have a groundbreaking on a 40 kilowatt system, a tiny system on the top of a storefront, okay? This industry has advanced so dramatically that if the last time you heard about solar was 5 years ago, it's changed out from underneath you. And it's just important to remember that this is it's a train rolling on in terms of larger scale, larger capital. And this is just an example of the scale. But, so a 40 kW system, you would need 50 of those to get to a 1 megawatt system. This year, our little team at our firm financed 1,000 megawatts. So 50,000 times that old storefront we were, celebrating.
When you say financed them, like what's that mechanism?
So our firm specializes in providing debt or tax credit equity for these.
Okay.
So the tax credit equity I can get into the mechanics if folks want us to do that. But the projects that we're going to talk about today are subsidized by a federal income tax credit that's based on the cost of the system. And in general, think about it as 30% of the cost of the system equals the credit. And for those developers or owners that have no use for the credit, they don't have enough tax appetite for the credit, they need to find an institutional investor, bank, another Fortune 500 company to take that credit in return for an equity injection. So that equity injection acts as like owner equity in the project, if you will, and helps pull down helps be part of the capital stack. So our firm helps the institutional investors invest in these projects.
Norm, is it safe to say that between the equity that would come in from an outside party and the bank's money, the developer doesn't really need to have a lot of skin in the game? They need to have know-how, but between the 30% that could come from an outside investor and 70% from a bank, there's not a lot more equity needed.
That's generally true, yeah. That's generally true. In fact, sometimes there's a fee coming out for doing this. I'd say today, though, there still is some equity going in. It's just largely bought down by the equity that comes from the tax credit.
Sorry, are you able to speak in the mic a little bit?
Yeah, I'll hold a little closer. Is this a little bit better?
A little bit better, thank you.
Okay, I can get it as close as you want. Is that even better?
Yeah.
All right, well, kudos for you for speaking up. Good job. Okay, well, we got to pick up the pace if we're going to get through these slides. Again, this is a survey, and we'll stop on some things that I think are interesting, or you just raise your hand if you see something that's a little bit more interesting. The overview of this tax credit percentage that we talk about for solar is it's 30% of the cost, effectively. And there is some fine print. There's kind of some, carrot and stick, I guess, in the IRA. You can get 30% credit only if you follow prevailing wage and apprenticeship requirements that have just come out, actually. So all projects eventually that are built are going to be prevailing wage. There's kind of a temporary grandfathering provision, but all of them eventually, are going to be prevailing wage. Okay, just moving on. These are some of those wage and apprenticeship requirements. Wage is just prevailing wage. You all know what that is, I think. Apprenticeship is a little bit more interesting, but essentially, even down to the smallest contractor, smallest sub, if they have at least 4 employees, they're going to have an apprentice program and comply with all these. So much of our discussion is, does every subcontractor know how to manage this apprenticeship program? So moving on, I think we talked about that. Another interesting topic here is that For those projects that source their content domestically, they get a boost to their credit. So their 30% goes to 40%. So we just call that the domestic content adder.
Domestic is territories of the US as well?
I think that's true. I think that's true. So you can get domestic content one of a couple of ways. One is you can have your manufactured products manufactured here. Another, you can have your steel or iron content produced here. It's the second that we see people really shooting for. So getting their racking, their steel racking here. But manufactured products, if there's just not enough supply here to domestically yet. There is also another adder for projects built in energy communities. And this is kind of a complicated definition, but we have some around here. So there's those projects that are in those locations. They're just extra special for development. That includes brownfields, and I bet you no one in this room can really define what a brownfield is. It's a tough one. And some other some statistical areas that had formerly gotten their employment from the energy industry. So that's a great adder, and folks are really looking at that. There's some around here, and if we can figure out what a brownfield is specifically, there'll be just that much more boost to the land development around here. There's also another adder for low-income communities. These are essentially census tracts. If anybody is familiar with New Markets Tax Credit, or at least passingly familiar with New Markets Tax Credit, you know that in New Markets Tax Credit, to be eligible, you have to be in the right census tract. This is the same census tracts. So whatever you were doing to map new markets before, now you can get this adder. This is an adder that's governed though. It's a volume cap adder. It's going to be allocated by the IRS, once a year maybe. We don't know. They're still working on the program. So you can't really count on this adder until you're awarded it, and nobody's been awarded it yet. There's also another adder for projects that support low-income projects, low-income buildings, or low-income communities. And you can kind of read that there. But again, this one is also awarded based on a national volume cap, so no one's been awarded this one as well. Many of our low-income housing developer customer clients in our firm are considering, I would say it's more often than not, when they're building a new project, a new Section 42 project, they are considering putting solar on the roof. Does it make an enormous impact on the building? It makes some impact on the building, but it's almost like an automatic add-on now. We're putting solar on the roof, and this is one of the things that might help them, kind of help make that even more universal.
So you have clients that are combining the low-income tax credit, the solar credits, and other credits to get more bang for the buck?
Yeah, that's correct. I would say, again, probably more than 50% of the buildings that we work on that have a low-income housing credit already are putting solar on the roof. So they're going to generate some energy credit, and they're finding out a way what to do with that energy credit. Typically, they're just giving the energy credit to the same investor who's taking the low-income housing credit. Just kind of bundling them, if you will. So it's becoming pretty much, common, very common.
From the developer's point of view, what's the economic benefit? They get outside money to basically put all the skin in the game, or most of it?
Yeah, from the developer's standpoint, a lot of times the rooftop system on a low-income housing project will run against the house meter, for example, and it'll at least cover the house meter. And then if they want to get more fancy, they can do some other things. So that's decreasing the operating expense of the building. And ultimately you get, that system probably pays for itself in 5-6 years, something like that. And after that, that reduction in operating expense is it's just free for the building. So how developers are using that is kind of up to them. But a lot of them are just, kind of using it to defray the overall electrical cost of the building. Did that answer your question?
I think it's a wonderful concept to add these components to make your project more economically viable and to encourage outside investors. And if developers can get in skinny with little or no skin of their own in the game, I think they're going to be able to do deals much more readily, right? Because they don't have anything at risk.
Yeah, for the solar projects on the roof, oftentimes, so you got the credit, which is covering maybe 40% of the capital cost. There might be some local incentives. There might be some contingency savings from the underlying building itself. Because remember, you just, got to have a roof before you can put this thing on. So you've already built the building. You have some contingency there. Usually, if there's any contingency left, that's kicked into the solar, plus the incentives. And that is usually enough to pay for it.
Was there a max credit that you can get back as the owner of this? Like all these 10% kickers, like is it 30 plus 10 plus 10 plus 10? So now you're at 60%, or is it?
I think the max works out to be 70 in some theoretical universe.
Okay.
I don't expect to see those. All right, moving on. So energy storage is, as I mentioned, battery storage. Think modular lithium batteries, okay, that come on the back of the modules fit on the back of a semi-truck. Think of those, the technology is prepackaged with lithium batteries inside, and think of installing 1 or 10 or 100 of those, and using that as a backup power system to sell into the grid during high energy use periods. Noon on an August day in Minnesota, or other energy peaks. So the problem with one of the problems with solar is it curves up during the day and then falls off. So at the shoulders, if you will, of that curve, morning business rush hour and the evening business rush hour, when you got your lights on, you got your kitchen going, it's useful for the grid to have some other sources, and energy storage is becoming cheaper. It's something that it has to go with solar somehow. Solar is not itself unless we all want to turn the lights off at 5 o'clock. We have to have something that'll get us through. So I would say on more and more of our projects, we're seeing a battery storage component added. And not to tout our firm, but we're working on the world's largest battery. This is in Australia. If you can zoom in, each one of those this is a rendering obviously, but each one of those is a module. Like the back of the truck, semi-module. So I don't know how many there are down there, a few hundred. And our role in these is we actually represent the battery manufacturer, supplier. We just, we represent them in supplying the battery to the developer. We'll probably skip that. All right, one interesting thing is that for those kind of entities that don't have a tax liability, they don't have a tax bill, the city of Brooklyn Center or whatever, state of, who knows what, they previously had really no way to monetize this tax credit. So they were, if they wanted to own it, they had to just pay full price, no credit, and they just forego the credit, or get into some kind of complicated arrangement with the developer where the developer would continue to own it, the developer would take the credit, bring down the capital stack like that, and then finance the rest. Well, starting next year, those kinds of entities, cities, states, tax exempts, they actually now could qualify for, if they want to own a project, they can qualify for a direct pay a check in lieu of the credit. So we don't know all the processes around this, but it's definitely helpful for the nonprofits and the munis of the world who maybe don't have access to this complicated kind of developer-owned system, and they just want to own it. They've got some capital. They would like the tax credits, for the rest of the capital. So this is an interesting one, and I don't know the applicability, but for those of you that have, customers or contacts in that world, the tax exempt or muni world, just be aware that this is a brand new tool for them.
There's different kinds of nonprofits, 503c, 5 and 7s and so forth. Is there any distinction between the different kinds of nonprofits that you're aware of?
There might be, but tax exempt is a big lump bucket that I use. I'll call you if I need
I don't know.
to
We'll have to research it.
Yeah. Okay, and one of the things another exciting thing that, kind of a sleeper excitement thing, is that credits can be transferred now. So I'm gonna have to just take a step back for a second. We're talking about institutions buying these credits. Generally, as the general users of these credits. The reason why you, me, everybody in this room is not generally, in this market buying solar credits is because of something called the passive activity rules, passive activity loss rules. Whatever business you're in, it isn't solar right now. So if you tried to invest in a solar deal, that solar activity is passive for you because you're not participating in it. You're just kind of a drive-by investment. Here's some money, try to get some credits. That's the definition of a passive activity. That's why all of us, and the trillions of personal income that's available in the U.S. is not available to buy solar tax credits. But that might change. So beginning next year, credits now don't necessarily need to be just allocated on a K1 to a partner. Beginning next year now, a credit can be just a piece of paper transferred to you. And it that doesn't exist in the federal code yet. It's something brand new. It's like just out of the blue. Well, let's have a transferable credit. So we all thought, well, what does this mean? Like, what's this going to be? There are some state transferable credits, but that's not exactly applicable. There's some old guidance on new markets credits that indicates that somebody who just bought, he did what was required in the code and just bought an interest that got him new markets. This guidance indicates that wasn't even an activity for him. So if it's not an activity, it's not a passive activity. So if you get where I'm going with this, maybe buying credits, maybe buying a transfer credit, buying a piece of paper is not an activity. And if it's not an activity, it's not a passive activity. And therefore it's not subject to the passive activity limitations. Many of us have commented to the IRS that when they issue their ultimate guidance, boy, we'd really like to get this clarified. Because instead of just dealing with, the same few hundred institutional investors, and those folks being the entire market for credits, there's a lot more credits here. It wouldn't be nice if there was a bigger audience. So just, why don't you just think about that? If that comes out the way we think it will, there might be a lot of, many institutional or investment banks putting together funds for high net worths or other accredited investors to participate in something like this. Any thoughts?
I think Scott Miller right now is Googling tax credit crowdfunding so he can get the domain name. I'm pretty sure he's doing that right now.
All right, any questions on that one before we go on? Because that was not obvious, I think, when the IRA was enacted, but it could be really a significant change to our industry. Nothing, no questions on that one. All right, moving on. I think we talked about transfer enough. One more thing that happened in this IRA was that the credit used to just be carried back 1 year. Now you can carry back 3 years. So people that have just sort of dipped their toe in for buying credits, but weren't fully in 3 years ago, they can now carry these credits back 3 years.
Can I ask a question? If I had a client that 1031 exchange failed 2 years ago and paid a lot of taxes because of that, do you think that they could buy some tax credits under this regime and go back 2 to 3 years and apply those newly purchased tax credits to mitigate their previous recognition of gain? Or would there be anything that would hamper that?
I think there is a hamper because I think the transfer credits cannot be carried back to a prior year. So I think that might trip us up there. Like the way you're thinking though, Jeff.
Love it.
Okay, moving on. We're almost to the end of these slides, but here's another one that's kind of quasi real estate. No one's heard of this one. This is a credit that's been in there for 10 years. It's a credit that was just that Congress had to fund in a one lump sum, and they did about 10 years ago, and then it was just dry all this time. Well, IRA refunded it to the tune of another 10 billion. So there's another 10 billion in credits for what really is just manufacturing plants. Specifically, not the real estate part of the plant, but the equipment part of manufacturing plants. And you think, okay, well, so if you have a real estate developer customer, and they're talking about expanding their plant, moving their plant, whatever, and they say anything about energy, or they say anything about the energy industry or energy conservation, or they say anything about metals, your ears should perk up. I list on the left here that the factory we talk about, this is the qualified advanced energy projects, and those projects are factories that are either recycling or producing various renewable energy equipment. That sounds boring, but there's so much in that definition that I couldn't possibly put in here. Carbon reduction equipment, again, or one of 50 critical materials. Believe it or not, aluminum is a critical material, and zinc and some other ones. So just 2 weeks ago, I wasn't even aware of this, and one of our clients who owns a local aluminum recycling factory or plant in the Twin Cities said, oh yeah, we're thinking about expanding. And somebody told me about this 45C credit. I go, 45 what credit? So I had to look it up, and believe it or not, yes. So this one could sneak up on you too. Just be aware if you're talking to a real estate developer or customer and they have anything to do with energy, it's worth a look at whether they would qualify for this credit. This is one you're going to have to apply for. There's a national volume cap, but it might be worth applying for. You got to plug in your electric vehicle somewhere. And so there's an expanded credit for people building the electric vehicle charging stations. There was one before, now it's expanded. Many of your real estate, customers, owners are probably being approached or thinking about adding some sort of vehicle charging station to their existing buildings. I mean, it doesn't take a genius to figure out that we're gonna need lots more of these, and they're gonna be located in convenient places, some at your customers' buildings. Just be aware, there's some incentives for that. There's also an energy efficient buildings deduction. This was a pre-existing deduction. So either building new or putting equipment in to a building. This used to be deduction, now it's an even better deduction. So somewhere between 50 cents a foot and $1 a foot for your entire building, if you do put the right energy equipment, energy saving equipment in there. And we're almost to the end. There's a bunch of grants that were authorized by IRA, a bunch of the grants. I couldn't even possibly list even remotely part of them here. But here are just the ones that kind of jumped out at me as, could we run across those in our daily lives? Possibly. States, cities, and school districts are getting, possibly big grants for buses, essentially buses and trucks going over to a clean version of that. Air pollution at ports, I don't know, where's the nearest port we got? Duluth, right? Climate justice block grants, kind of a vague definition there, but maybe more folks could qualify for at least applying for that than we think. Interstate transmission, and then energy or water efficiency at affordable housing projects. Didn't know that was even available. I mean, and probably your affordable housing developers don't even know that's available.
These are grants. This is free money.
Those are grants. Yeah, those are grants. Okay, last but not least, just a super quick list of some other stuff that's in there, the credits that we don't see a whole lot. There's a carbon sequestration credit. Think ethanol plant. What does an ethanol plant produce? Well, ethanol, but its only other byproduct is carbon dioxide, which is either just emitted or possibly purified and put into your Diet Coke, or could be taken off the system, out of the planet, and injected and sequestered forever. So Section 45Q is a credit for taking carbon off the planet and sequestering it forever. Believe it or not, it can be done. Clean hydrogen production credit, is what it sounds. Commercial clean vehicle credits, so a credit for buying those trucks that might convert your fleet over into something cleaner. Advanced manufacturing production credit, and then the last but not least, the stuff that we do, the energy credit and the production tax credit, effectively have a home now. They used to expire and get renewed, expire and get renewed, and now they effectively have a presence for at least the next decade. So very long-term expansion or extension of what we're doing. That's it. Thank you.
Thanks.
So I will tell you, Norm is one of the smartest guys I know, and he's one of the most friendly people. And
Go on.
if you are going to be doing anything with your real estate, and you want to think about ways to weave in tax credits to get free money from the government, a tax credit is a dollar for dollar reduction in your tax liability. It's beautiful. Or if you want to get grant money, free money from the government to do what they want to encourage people to do. I think anyone that owns apartment buildings that doesn't have an electric charging station yet should probably be making an appointment to talk to Norm. Or doesn't have solar on top of their big flat roofs to reduce their energy costs. There's so much opportunity for increased tax efficiency. You're probably going to make these changes and improvements anyway. Might as well do it with tax-free money. All right, I'm going to ask Patrick, our technology person to help us switch over from the PowerPoint to the standard modality here. So if anyone sees my associate Patrick, please ask him to come up here if we could.
I haven't seen them.
Would you take a look around, see if you can find it?
Yeah, probably like a 5-minute break or something like that.
All right, I just want to ask everybody here to ask me questions and to interrupt and to make this more of a dialogue and conversation. Because what I want to talk about is 1031 exchanges, which has been my bread and butter since about 1997. And Norm and I actually attended law school at the University of Minnesota together, and he went the tax credit route and I went the 1031 route. So we're kind of coming out of the same pot and growing in the different tax fields together. My business is to help owners defer their taxes indefinitely when selling appreciated real estate. And your gains may be from the natural appreciation that occurs over time, or your gains may be from depreciation deductions that have whittled down your basis over time. The goal with a 1031 exchange is to defer those gains and keep that money that would otherwise go off to the state of Minnesota and the federal government and use that money to compound and build your wealth over time. And I've told people that my mantra is to defer, 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 die. Because at the end of this run, when your heirs inherit the property, section 1014 of the Internal Revenue Code says your heirs inherit the property not with mom or dad's mega low basis from years and years of deferral, but is stepped up to the fair market value at the time of your death. Now, you may have other tax issues like an estate tax issue, but that can be dealt with life insurance and proper planning. So the beauty of this deferral is it can be woven into your estate planning and insurance needs, and many of my clients have been investing in real estate for years, sometimes decades, and because of their good management and their stewardship, and because of inflation and other demand for real estate issues, they've seen tremendous appreciation in their properties over time. And I would say some of them are disgruntled property owners now. They are tired of dealing with the troubles of management. The management has become more intense and has taken more of a toll on them in their later years. So they're looking to transition into different real estate types and different geographic areas. Some are looking to get out of high tax cold states and go down into low tax sunny states like Florida and Texas. Some are looking to transition into less management intensive, more passive real estate investments. The big financial services firms, for example, Morgan Stanley, Cantor Fitzgerald, these firms have figured out that there's a huge volume of investors who are tired of property management but don't want to pay the taxes, and they've developed real estate investments, sometimes referred to as DSTs, that qualify for 1031. They actually are completely passive and will allow you to defer your taxes. So we're going to see more and more people, I think, transitioning out of management-intensive properties. Patrick, could you switch our screen over to just live instead of the PowerPoint, please, and thank you. Now, nuts and bolts. I probably get a phone call once a week from somebody that says to me, I've already closed on the sale of my property, and I hear the word cha-ching. They've got the check. And they now want to set up an exchange after they've already got actual control of that money, either because they're holding the check or they have the ability to deposit that check. And I have to tell them, look, I can't take your proceeds after the benefits and burdens of ownership have shifted to that new purchaser. Once you've got a completed sale, the opportunity for me to set up the exchange has expired. You can't do it after the fact. But I feel like I'm getting punked, or at least potentially called by a revenue agent, seeing if I'm dirty or not, because it happens with such frequency that people want to set up these exchanges after the fact. So for the real estate agents and the real estate professionals and the trusted advisors in the room, my advice to you is to get the word out. If you think your client might want to do an exchange, get it set up before the relinquished property closes. Now, we're in late December 2022. If Norm does a 1031 exchange and puts his proceeds with the intermediary, intending to do an exchange, but his exchange fails in the subsequent year, perhaps he fails to identify his replacement property. When will his exchange fail? It fails at day 45 at midnight, which is in 2023. There is some nice interplay between Code Section 453, the installment tax rules, and 1031 that would allow you, even in a failed 1031, to defer those gains on the receipt of the cash that's not received until the subsequent year. So even if you're on the fence right now, not sure what you could potentially buy, you probably should set up a 1031 exchange to at least keep the option open for a 1-year tax deferral to trigger the gains for the subsequent year. Question from the audience.
I did one of those and I had people tell me that I was committing fraud, that I wasn't gonna do another property, but I was just pushing it down for another year. Can you speak to that?
Well, you do legitimately need to intend to do an exchange. You can't say, I'm putting my money with the intermediary with no desire to actually complete an exchange. I'm just playing the installment card. You actually have to have a legitimate intention to do an exchange. Now, it may pan out that you can't find something to identify, but you do have to be open to identifying. At a minimum, I think you have to have a somewhat indeterminate intention. But if your intention is just to work the system, no, that doesn't fly. And you also may have been told that as to any debt relief that you enjoyed in the prior year, paying off a mortgage on the relinquished property, that can trigger gain in the present year that cannot be deferred into the subsequent year. The only deferral that you're getting is on the receipt of the cash, the failed 1031 exchange funds that you actually receive in the subsequent year. So it can be a split baby, some now, some later, depending on how much debt relief you have and how much gain you had. Good question. Thank you for the question. And I would like to encourage more people to ask questions because I would like to make this a dynamic and kind of free-spirited discussion. So don't be afraid. I also want to thank Matt Thompson, who has been an ardent sponsor of our 1031 presentations. Like I said, we've been doing this for about 7 years. Before the pandemic, we only did them in a live modality. During the pandemic, we only did them in a virtual, and this year we're doing a hybrid where we have about 150 people coming in virtually and at least about 60, 70 people here presently who got up early this morning on this cold Minnesota morning to show up in person. So thank you, Matt, and thank you, U.S. Bank. When you do a 1031 exchange, you've got only 45 days after the date of the closing to identify. That rule was created by the service, who was given authority by Congress to write their own Treasury regulations. The IRS was trying to constrain, limit the number of people completing 1031 exchanges. That 45-day identification deadline is hard and fast. Unless you're affected by a presidentially declared disaster like the hurricanes in Florida, these are unwavering deadlines. The 45 days to identify and the 180 days to complete your purchase. They don't want you to succeed. They want you to fail because then you will have to pay the taxes. So what are the smart, clever, experienced real estate investors doing?
Finding the property first.
They are finding their replacement property first. They are getting a sure thing lined up whenever possible.
Trying to, anyway.
Trying to. I am seeing a lot of very large transactions going down. 35 million, 90 million. These are mega transactions in my world where I typically do mom and pop, medium-sized exchanges. They do not make a $90 million move unless they've got a sure thing lined up to acquire as the replacement property. They are not going to make a move like that. And even the mom and pop investors now selling single family rentals, duplexes and fourplexes are thinking ahead. How can I get that replacement property locked up under contract? Logistically, some sellers are entering into a purchase agreement with their buyer and saying, buyer, I'm happy to sell to you at this price, but I, as the seller, get to control the closing date. And we're not going to pull the trigger on a closing until I've got a replacement property under contract or under option. Now that works fine when you're not in a rising interest rate environment. But right now, we're in a rising interest rate environment where banks are not going to let potential purchasers and borrowers get that rate lock for a real long period of time. So there is a tension between the buyer and seller where the buyer is chomping to get this deal closed and the seller is reticent to take the plunge until they know what they're going to exchange into. All right. We see a lot of people right now doing what is called a build-to-suit exchange. This might be where we could layer in some tax credits on top of it. That'd be the cherry, right? Get the tax deferral and we get tax credits. They are moving out of facilities they are cramped in, where the regulatory municipal government doesn't really like them anymore. And they are selling that property, maybe in Minneapolis proper, and rolling out to the outskirts. Maybe they're moving to Ramsey, Minnesota, where the land is less expensive and the government is more receptive to their business. And they are building out new facilities to their specifications, built to exactly what they need to maximize the efficiency of their business. And they're doing it with tax-deferred dollars. The qualified intermediary can acquire the land, hold title to the land during the exchange period, and during that period of time, expend the remainder of the exchange funds constructing improvements on that property, which is a huge benefit. Question?
Does that have to happen in the 180 days?
Does it have to happen within the 180 days? If you want to do a safe harbor exchange, the answer is yes. You got 180 days, which starts from the earlier of the closing of the relinquished property or the acquisition of the replacement property in a reverse exchange. Now, if you want to get fancy, let's go outside of the safe harbor. Let's take a look at a case called Estate of Bartel, where the intermediary took 17 months to construct a new facility for the taxpayer to exchange into. The Estate of Bartel is a case out of the Ninth Circuit, California case, and the taxpayer won across the board. IRS did not appeal, but they did file a notice of non-acquiescence. They didn't like the outcome. So non-safe harbor comes with a little bit of risk. But if you want to do a big construction project, you can't do it in 180 days. You need more time. It's a practical necessity to go outside of the safe harbor. Questions? Yes, sir.
So if you do that, and we're building say we're building a warehouse, and we can't get the property that we're trying to sell, you're saying there is no limit? Is that what I heard? For you to hold that property till I can get my relinquished property sold?
Yes. What your question is in a non-safe harbor exchange where the intermediary is acquiring the replacement property and constructing its improvements. In a non-safe harbor exchange, there is no maximum time frame that the intermediary can hold the property. There's no cap. And it's a matter of contract between us. Should I hold the property for 16 months, 20 months, 24 months? We can contract to determine how long the intermediary's maximum commitment or involvement to this transaction is. And furthermore, we could amend our contract and extend it further if we needed more time to get more improvements constructed or to offload the relinquished property. So going outside of the safe harbor has some significant advantages, but it also comes with some risk in that the service doesn't really like these non-standard or what I call non-safe harbor exchanges. They don't love them. But there's substantial case law and authority that they are legitimate. All right. Yes, go ahead, Tom.
Jeff, I've heard you talk in the past about, excuse me, clever investors that are burying their gains in raw property, raw land, how that works.
So normally raw land is non-depreciable. You cannot depreciate it. So it's kind of like it's the cost of doing business. We got to put money into the dirt. And we can never recoup our outlay for the dirt until we eventually sell the dirt. What some investors are doing is they're taking an apartment building that they've fully depreciated. They ran it down to zero. They have nothing left in it but the dirt maybe. And they have maybe a $2 million gain from the sale of this $2 million apartment. And they're taking that $2 million and using it to like-kind exchange into a $2 million plus piece of dirt. They're burying their gain in the dirt. And I think this works with any 1250 gains. It would not work with accelerated depreciation because the accelerated depreciation would require matching shorter-lived components. So it works nice with straight line traditional depreciation. Wouldn't work as well if you did a cost seg, but we could buy other replacement properties to cover your 1245 if we had to. So the nice thing about buying the dirt with your 1031 money is you're burying that gain in an asset that could not have been depreciated otherwise. Then later you construct your improvements on top of the ground estate that would be created for the development entity, and you'd have fresh basis, completely fresh, brand new basis in your new improvements that would be constructed. Right now we're working with a client that may sell a $4.5 million property in Minnesota, pretty much fully depreciated. They're going to buy a $7.5 million piece of dirt, potentially, in Chattanooga, Tennessee. Okay? They're going to take their gains and bury it in that dirt, in that parcel, and then do the new improvements later on top of that ground estate that they'll create.
But Jeff,
do they have to build an improvement on top of that for the 1031 to succeed, or is the 1031 successful even if they didn't improve it?
If the value of the dirt exceeds their net sale price of the relinquished property, so they're continuing their investment into property of equivalent or greater value, they need not make a lick of improvements because they've already got the value. The reason you do a build-to-suit exchange is that the unimproved piece of dirt isn't of sufficient value to fully defer your gains, and you want to construct improvements with your remaining exchange funds. Question?
Do they have to fully depreciate the original improvements?
You do not have to have a fully depreciated relinquished property, but the more depreciation you've had in the past, the more your potential gain is if you were to sell it outright. And so an extreme example is somebody that has owned a property long enough to depreciate down to zero, to have nothing left in basis. And that's a person that I call is pregnant with expectancy. They should do a 1031 exchange or they're gonna have to deliver a large tax bill to the IRS. Question, sir?
Are you able to take a property that you've depreciated, say you've got $2 million in depreciation, and you buy a next property's $1 million, so it's lesser value? Are you able to still roll the $1 million forward? And then second follow-up question would be, what if you had two other properties that you were purchasing, one of $1 million and $1 million? Would you be able to take the one property that you're selling with $2 million of depreciation and spread that over the purchase of two other properties?
I'm not sure if the camera is picking up your audio, so I'm going to try to repeat your question. First question is, can I sell a relinquished property worth $2 million and acquire only a $1 million replacement? And the answer to that can depend on how low is your basis on your relinquished property. Because the first thing that happens when you do a 1031 is that your old basis transfers to the new property. And you only really start deferring gains to the extent that you buy real estate over and above your transferred basis. Well, if your basis was zero, you have a $2 million gain, and you buy a $1 million replacement property, you're going to defer half of your potential gain because you'll have acquired a replacement property worth $1 million. That'll defer that portion, but the remainder of the gains would be recognized, and it would be a partial 1031.
Okay.
Now, the way to fix that problem is to identify multiple replacement properties and close on enough of those identified properties so that you're deferring all of your gains. If that's your goal, is to have absolute 100% tax efficiency, then you need more replacement property. Or you could identify the improvements that don't yet exist that need to be produced and have the intermediary construct those during the time frame in what would be called a build-to-suit exchange that would be constructed within the 180-day time frame. I got a call yesterday from someone that basically buys land, puts up these, they're yurt-like structures, semi-permanent vacation. They're not tents, but they're not yet cabins. They're kind of dome-like structures in the coldest part of the Upper Peninsula of Michigan. And there's no way for them to do the construction during the cold winter months, which is what would be necessitated by their timeline. So they're going to have to forego the build-to-suit, not because they don't want to do it, because it's too cold, too remote for this kind of construction during this time of the year. Any other thoughts or questions? Yes, Scott?
Right now I'm involved in a deal where, right now it's an estate deal, the property's in a trust for the kids. If they sell it, can they take part of it as a contract for deed and still take part of the money to go into a 1031 exchange, or?
So Scott's question is, his clients are going to be selling a piece of property. They may entertain seller-backed financing, what we call in the Midwest a contract for deed. I personally prefer that you don't engage in any seller-backed financing because I want you to buy replacement property of equal or greater value and have equal or greater equity in that replacement property. If you do seller-backed financing, your equity just got loaned to the purchaser. You don't have the equity to redeploy into the replacement property. So from an accounting perspective, that could trigger the recognition of some gains, but there's an easy workaround. You may have heard the expression at US Bank that cash is king. If you have cash, you can loan that cash to your buyer, bring the amount that is being loaned from the seller to the buyer, bring it to the closing table, have the seller fund the loan to the buyer right on the settlement statement so that the net proceeds that go to the 1031 exchange and are ultimately redeployed into the replacement property are the same as they ordinarily would be without the seller-backed financing. And there are other workarounds, and we can explore those and tailor a solution to your client's specific situation by working with their attorney and their accountant and maybe their banker. Because when cash is needed in a creative situation, It's nice to have a nimble, creative, and sophisticated lender like US Bank to help you solve that problem.
Gotta be agile.
You have to be agile. Your banker can be your best friend when you need to fix a seller-backed financing situation. The better result, though, would be to just tell the buyer, get your own mortgage. I don't want to be your bank. But not everybody can do that, right? Some properties that seller-backed financing is required. Any other questions that we want to address? Yes, sir.
Just the one about when the guy took the $4 million to Tennessee, how long is Minnesota gonna follow that transaction?
I don't think that Minnesota follows like some other states do. California claws back that California source gain. If you ultimately sell the Chattanooga, Tennessee replacement property, California jumps out of the weeds with their hand out and asks for that gain that you deferred when you sold out of their jurisdiction. Minnesota and most other states fully conform to the federal model and allow you to defer your gains out of Minnesota. Now, Minnesota also benefits because a lot of investors are bringing money back into Minnesota as well, so it's probably a wash for them. And there was another question next to you, I believe, as well.
So if you have a partial 1031, like the previous example, $2 million, you counted the $1 million property, the gain, let's say you do have some sort of leftover basis in the property, the gain, how's that gain allocated? Do you get proportional by fair market value, or do you get like all or nothing on the extra $1 million put in your receipt because it's cash?
Well, let me do an example for you.
Hey, Jeff?
I'm going to repeat that question.
Yeah, there you go. Text from online people.
All right, question is, how do we calculate the amount of deferred gain on a partial 1031 exchange? And in a partial 1031, you're only deferring gains to the extent that you're buying replacement value over and above your transfer basis. So let's say that you sold a property for $2 million, but you had a $250,000 remaining basis in the old property, the relinquished property that was sold. So the first thing that happens if you buy a $1 million replacement is that your 250 basis transfers or slides over to that new acquisition. And you only then defer gains over and above that transfer basis. So on a $1 million replacement property, you'd only be deferring 750 because you had a transfer basis of 250. And then because you still have $1 million of gain that you haven't deferred, because you bought an insufficient amount of replacement property, you'd be recognizing the gains on that remaining million, unless you could buy and close on additional identified properties to mop up that extra gain. Now, some clients are okay doing a partial 1031 exchange. They will plan it from the get-go because a partial exchange is still better than no deferral. But my preference, because I'm a zealous advocate for tax deferral, is to plan your system out and buy enough replacement property that you get an equivalent or greater value and an equivalent or greater equity, and you offset your debt relief, if you have any, to maximize the exchange. To your point, sir, would you rather give the government 35% of $1 million, or would you rather take that money and give it to a real estate syndication sold by a financial services firm? Because in a highly leveraged DST, Delaware Statutory Trust Alternative Investment that qualifies for 1031, you may be able to get $1 million of replacement value for the same outlay that you would have given to the Fed and the state. And in 10 years, that money that you gave to your financial planner might be worth something. Whereas the money that was paid to the state and the Fed, what's that going to be worth to you?
Why are you looking at me?
Nothing.
I'm not the state of the question.
This bad guy is wearing the black hat.
Jeff, can you expand on that a little bit? Starting by just saying, look, kind of recapping what the options are for somebody who was actively managing some real estate. Now they say, okay, I want to be passive from here on out. Can you just recap like what are all the passive options they might have available to them, and then expand on that? It almost sounds like that DST sounds almost like you're throwing something into the real estate market.
There are so many variations of replacement property, from the traditional brick and mortar investments that we're all familiar with that are sold by real estate brokers like Scott Miller. Some of those might be triple net leased single tenant properties. We, not too long ago, had a client that bought a single tenant, triple net leased fleet farm for like $7 million. That was one of his replacement properties. He was tired of dealing with toilets and tenants and, just the management. So he wanted to buy a single tenant property that he could just collect the rent passively. So traditional real estate is always available, but also the financial services firms. There's an attorney named Phil Colton that does a lot of securities regulation work in the Minneapolis area. And he is a sage wealth of information for groups that want to create real estate syndications and sell them as securities, where they qualify for 1031, but they're marketed through financial services firms like Morgan Stanley, Cantor Fitzgerald, Ameriprise. That's a whole nother realm that in the past we hadn't thought about as a place to look to for replacement property that qualifies for 1031. Relatively new trend that maybe started in the 2007 era and has really blossomed as another avenue in which one could reinvest their 1031 funds. And many estate planning attorneys like these DSTs, Delaware Statutory Trusts, because if you want to cause family acrimony from the grave, leave your children an apartment building to manage. Because one of the children will probably be responsible and step up grudgingly, to do it, and the other 4 will be armchair quarterbacks telling them how they're not doing it right. And trying to get money distributed out of the partnership to the kids, right? So it would just be an awful way to let your kids be tormented from your grave. Instead, by buying a Delaware Statutory Trust, which is a divisible asset, you can let your heirs inherit fractions of that portfolio. And then, Susie can decide to sell her interest upon the death when she's got the step-up in basis, and Bobby may continue just to receive the passive incremental income that's provided by these investments. And each child can make their own decision unilaterally and separate from the others. Now, within the realm of DSTs, there's 2 different big categories. There are DSTs that just run their life as a Delaware Statutory Trust, and at the end of that run, when the syndicator's benchmarks have been hit, the DST will roll over. There'll be a liquidation of that asset or assets, and you'll have the opportunity to take your cash at that time in a taxable transaction, or to do another 1031 exchange and defer again. You could go back into traditional real estate, brick and mortar, or you could go back into a DST. The other kind of DST is one that is designed to morph into a REIT, a real estate investment trust. After 2.5 years, the DST is contributed in a Section 708 contribution, 721 contribution, I mean. And you're basically in an umbrella partnership, and the only asset of the partnership is the REIT shares. So you're basically in the REIT. And you have basically combined 2 1031 tax deferral strategies, the 721 contribution and the 1031, to get into a completely diversified, big portfolio of high-grade commercial property that will kick off a nice, steady, reliable stream of income to you in your retirement years, and it would be nice and divisible upon your death so that your heirs could divvy that up after your demise. One more question.
So when you're in a DST and you die, what does the stepped up in basis, does that property have to be reappraised or your fraction have to be reappraised at the time of your death?
So when you get a step up in basis upon the death of the owner, that is triggered by the death of the decedent or the date that the asset is appraised for estate tax purposes, which is generally, soon after the death of the decedent. So if you have a large enough estate that you have to value that asset, you may have to get an appraisal, but these may be self-appraising in the sense that the market will determine what the strike price is for the sale of your REIT shares, right? You may just liquidate them at the predetermined price. I would ask that you talk to your financial planner about how much you can liquidate. Recently in the news, there was a private REIT called Blackstone that has controversially decided to limit liquidations because there were too many people liquidating all at the same time. So talk to your financial planner in advance to know, when may I liquidate, how much may I liquidate, and how is the strike price determined when I liquidate. You need to know that up front before you commit to this type of DST that could convert to a semi-publicly traded REIT. Great questions. All right, I am in downtown Minneapolis. I've been doing 1031 exchanges for 20-some years. Norm is with Winthrop. He's been doing tax credits for as long as I've been in the business as well. And there are so many different wild synergies between real estate and tax. Incentives to do what the government wants done, encouraging you to undertake purchases of properties that you wouldn't otherwise normally purchase, or develop a type of property that you wouldn't ordinarily venture into. But the tax incentives are so tremendous that not using these extra tools in your real estate development tool belt would be a sin. So I encourage everybody that's doing anything with energy, metals, manufacturing, to talk to Norm before taking the plunge and figure out how you can weave in some tax credits. He's the best in the business. And if you're going to do a 1031 exchange, well in advance of your sale, let's talk about how I can act as your qualified intermediary and facilitate the mechanics of your 1031 exchange. And if you need to borrow money, or you have a large amount of money to deposit, Matt Thompson and his team at US Bank are very capable lenders and have been doing business in Minnesota forever. The old First Bank building in St. Paul is one of my favorite landmarks. So thank you to Matt Thompson at US Bank for sponsoring this event today. Thank you.
You on? All right, any more questions for Jeff or Norm?
On the,
Wait.
Oh, sorry.
Jeff, could you repeat the name of the attorney that you recommended with respect to more or less, I guess, a syndication of deals?
So one of the biggest barriers in doing a syndication are the securities rules, right? There's a lot of securities restrictions, and these are rules that are loosening up a little bit, kind of getting closer to crowdfunding, but not quite there yet. So Phil Colton is a really good guy in the Minneapolis area. There are other very good securities attorneys, but I like Phil. I like how he can explain things in a very understandable way, and he's very down to earth.
And his firm is?
I don't recall.
Winthrop and Weinstein.
Oh my God.
It worked out great.
Well done
I'm glad it worked out as well as
Pretty good. Brian, did you have one?
I got a manufacturer client who's gonna start a solar panel, project up on the roof. Do they need to just start the project in 2022 to then finish it in 2023 and then qualify for tax credits to retro back to 22 tax return? Or does it even matter when they start that project? They can always go back.
Good question. The question is, when do the credits vest and what are the consequences of when you start? The credits vest, they're generated when the project is completed.
Okay.
So the credits are in the year in which the project is placed in service. There are other implications about when you start. For example, do these wage and apprenticeship requirements apply to you? Or we don't have adders until projects are placed in service next year. So if it's a next year place in service or thereafter, you could qualify for some of the adders.
Thank you.
Any other solar questions? Solar?
You want to take questions? Okay. Well, we have.
Maybe you.
I'll go. All right. I think we have the room booked till 10:30 or 11, Jeff. I don't remember. So are you two able to hang around, Norm, Jeff, for additional questions? So, again, I want to thank these two gentlemen for sharing their expertise. I will plug the 1031 again for Jeff and his team. He makes it really, really easy for a simple banker like me to do a 1031. So, looks like we got plenty of coffee left, bagels, whatever you want. So you're free to leave, I guess, or hang out. Will you share the deck if people want it? Perfect. Okay. Well, again, thank you, gentlemen, for sharing expertise. Thanks to everyone for coming today. And online, if you have any questions, you can email me or Jeff or Norm. All right. Thanks, everyone.
Thank you, everybody.